We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. I'm Gabe Johansson here in the studio with the one and only Mike Nuss, Wonder Boy Dane McKinney, and a very, very, very special guest today. We have Arie van Gemeren. Welcome to the show, Arie.
Thanks for having me. Already been a good time in the studio.
Man, isn't it just fun to do this in person? I thought we were going to be on Zoom today. I was so excited to see you when you walked in. It's just so much better to be one-on-one.
Yeah.
Okay, I want to introduce you. Help me if I screw this up. You are the founder and CEO of Lombard Equities Groups. You lead a West Coast real estate firm managing tons in assets. You're trying to scale to about $500 million. You have an institutional finance background from Goldman Sachs. You have a very long resume. You've done lots of cool things. You're an athlete. You're a UC Davis grad. Am I missing anything? Like, you're an impressive guy, and I hear you're a public figure. You've got a very large social media presence, and now that you've been on Deal Junkies, this is going to blow up.
This is the launch pad, boys.
Are you ready for people to stop you on the street and want selfies with you?
I'm ready to lose my anonymity in life. This is it.
This is it. Your private life is gone.
Do you have private security you can hire?
All right. So, Arie, we want to dig in, and these guys will have some questions for you. But what I like to do is start with you. What you've done is obviously very impressive. The reason you're sitting here is because we want to talk about real estate. But talk a little bit about you as a person. Like, did you know when you were young this is what you're going to be doing? Were you entrepreneurial? Did you grow up in a background? Can you take us back to just whenever you want to start us and kind of tell us your story?
I mean, I distinctly remember as a kid looking at buildings and thinking, like, I want to build something. I remember that distinctly. I remember going to the airport, going to SFO, San Francisco Airport for the uninitiated, and trying to, like, looking around and being like, I'm going to be a construction guy someday. And that was a young child memory. And then it kind of went away. Like, I was always good at English and history, and so, of course, that led me towards a belief that I would go to the law, and I was going to be a lawyer.
Oh, a lawyer.
My plan. Okay. I'm glad I didn't go that route. But, you know, I mean, I think I had a fairly entrepreneurial family, not in a traditional sense, but my father was a cardiologist, was a doctor for like 45 years. But, you know, the upbringing story of my dad was always, my grandmother was a Holocaust survivor. The family fled to South America. My dad came to the States when he was 18, was homeless for like a year, didn't speak a word of English, figured it out, put himself through school, went to medical school, became a doctor. He always told me, like, the thing that saved his family was in L.A. when he was living in Los Angeles. He bought an apartment complex and put my grandmother in it, himself in it, and that, like, fed the whole family and kept everyone alive in L.A. Unfortunately, he sold it. I wish he'd held on to it. But he moved, you know, and then he went to medical school, went to the VA, went to Northern California, and became a cardiologist and had a tremendous career in the San Francisco Bay Area. And that story always really stayed with me because being the child of, you know, people that had to scrap to survive. Mm-hmm. You know, my dad lost his own dad when he was 12. His father died my grandfather died in a plane crash. So my dad grew up without a dad, had to kind of provide for the whole family, was sort of like the patriarch of our family. And it was always impressed on me, like, you got to, like, look what my dad did. Like, you got to step up to that. Like, you got to try to live up to that memory. And so my dad always spoke really well of real estate. Oh, you know, I know so-and-so bought a property, and then he bought another property. And so it was always kind of in my head that real estate was interesting. But life went a different route, right? I went to UC Davis. I was a Division I swimmer while I was there, and I briefly looked at going to the Marine Corps. I went to officer candidate school, and then fell in love. So that was sort of the thing that killed the Marine Corps dream. And so I got out of school in 2009. So I graduated in 2009. And I wish I knew what I knew now in 2009.
Don't we all?
Slayed it. I slayed it. Yeah. But I didn't do it. I kind of bumbled around and tried to figure out what to do with my life and thought about going to law school. And then I got into finance. And I really wanted to go to finance. And it was tough. It was a really tough transition because, you know, for all of us to live through that time, getting a job in finance after the GFC.
Getting a job at all, but definitely in finance, really difficult. And I had the added negative of I only studied history, poli-sci, and philosophy in college. So, like, you know, no background,
the most useful degrees imaginable, right?
Yeah, it sounds like you became an analyst, not an advisor.
I did. Yeah, exactly. Well, it's funny. I actually started my career at Fisher Investments, which is a fantastic firm.
Yeah.
And
They're an actual fiduciary.
They're real fiduciaries. You've seen the TV commercials, but big office in Camas, huge presence up here. And I got my first gig with them. And my first job was a client service associate managing paperwork. And I will never remember like the shame and humiliation of going back to school and telling my buddy what I was doing. And he's like, "Oh, so you're a secretary?" Like,
No.
no,
I am a
client service associate. But it was interesting because, it's interesting to detour slightly, but like I think one of the curses of being a Division I athlete that I noticed is a lot of like you're kind of special in college, right? Like you get a special meal plan and special consideration, and you can get into classes other people can't. But a lot of the guys that I went to school with, they were athletes. Like they had a hard time taking like a regular job after that because it was like oh, I'm special. I'm like a cut above.
They peaked early.
They peaked early, yeah, a little bit. And so like my buddy was saying that to me, and I was kind of like, okay, thanks. But I just knew like you had to get started. You had to get your foot in the door. And so that was kind of the start of my finance career. So I was at Ken's firm. I did the CFA, which was a brutal 3-year course of study.
What's CFA?
Chartered Financial Analyst.
Okay.
So it's a 3-year course of study, 250 hours of study time per test. And I started that right when I got married. So God bless my wife. Like we were on our honeymoon in Maui, and I was like, I'm going to do this test. And she's like, okay. So she like didn't see me for 3 years after we got married. But it was like the launch pad, right? And so, but I was like really embedded in finance. Like and Fisher Investments is really pro stocks, right? They're like stocks are the best, always do stocks. And I really, drank the Kool-Aid for lack of a better word. And I was like, yes, stocks are the best. And then my first real estate deal I ever did, was our first house we bought. And that's kind of the thing that got my taste for real estate. So my wife's Iranian or Persian, and not to make cultural stereotypes, but like Persians love real estate, right? Like a lot of immigrants to the United States love real estate. It's just like in their blood. They love it. And so we had all this stock portfolio, and my father-in-law was like, you got to buy this house. And I was like, I don't know, like kind of like having stocks instead. Like, I don't know that I want to sink money into a house. And this was 2011. And he's like, no, you have to buy the house. Like, trust me, it's going to work out. And so we bought a house in the Bay Area for like $510,000 in the East Bay. And they saw something in the house that I hadn't seen. And they were like, look, it was like a rectangular house, and half of it was a master bedroom. And he's like, we can split that in half and make it into 2 bedrooms. And there's 1.5 baths. Let's make it 2 full baths and like complete the, there was like a drive-in. It was like a, what do you call it? Not a full garage, but like a carport.
Yeah.
Thank you. So we put like $60,000 into it, and it was like we were scraping bottom every month, right? Like my father-in-law had some guys come out. They were working, and it was like a monthly pay system, and it was really slow, and we had no money the whole time because we were paying for it. But it was like $60,000 of investment in the house, and we lived in this house with like billowing sheets and dust everywhere. But at the end of it, the home reappraised for like $1 million. So we bought it for $510,000, and I put down 20%. Put $60,000 in and made like $400,000 of equity.
And you're like, whoa, my stock portfolio didn't do that.
I'm not going to do that. I was like, this is incredible. This is inspiring. So then I went to Goldman, and I was an advisor at Goldman. So I was in the equity research department at Fisher. So we're doing stock market analysis and research. And I went to Goldman, and I was the CIO of a team, so helping kind of select investments for a $4 billion book of business. And at the same time, I started doing prospecting and meeting investors, and I started getting this common story of like, oh, a lot of these families have built a lot of money in real estate. And I'll never forget, there was a Lebanese guy who had a great tech company, and he's like, Arie, since the day I got here, I just did what my father told me. I just bought real estate. Every dollar I made, I bought real estate. And he goes, and I didn't know that Santa Clara was going to become what it would become, but like, look at me now, and like I make more money from my real estate than my tech company. And that story kept repeating over and over. So I got really into it. Started listening to Brandon Turner before he went off on his own on Bigger Pockets, and read everything I could get my hands on, and started buying property. And that was kind of the start, and I was like, I wanted to put my own money to work, buy my own deals, and I did. And I started in Portland, was my first market. So,
why Portland?
Because it's the best.
It's the best market.
Jeez, dude. What a question.
So it's an interesting story. So I was in the Bay Area, and I was looking at buying in Oakland or San Francisco at the time. And the price per door in that market was much higher. Mm-hmm. And Fisher had just moved their headquarters up here. And so I've been on the receiving end of a lot of like firm marketing, we'll call it marketing, that we should all move to Portland because it was so much better and like the firm was coming up here.
Isn't that called brainwashing?
Yeah, propaganda, whatever you want to call it. It was like,
manipulation.
Hey, you gotta go. This is so much better. You should move up here.
Employer propaganda.
So I already had an association with the market, and then my wife's sister and her family moved up here. So we started seeing Portland a lot. So I looked at it like blackjack. It was like I could go to the $100 buy-in table or I could go to the $10 buy-in table. And I wanted to go to the $10 buy-in table, which was Portland. So that was really the start of my interest in Portland. So we started buying plexes in Portland and just one after another and refinanced the house, used the equity that we'd made on our home to buy additional apartment complexes up here. And that was sort of the start of the real estate journey we've been on.
So you start building a personal portfolio. Where does the story turn to you becoming like building an actual syndication? And
were you still at Fisher at the time, though?
No, I was at Goldman when I was buying.
That's what I thought you were saying. So Fisher moved up here, and then you moved to Goldman after you moved to Portland.
No, so Fisher still has an office in the Bay Area.
Sure, but headquarters moved up here. Sorry,
their headquarters moved up here.
Yeah.
I was working out of Ken's house, so he had a beautiful estate in Woodside. For those of you that don't know, Woodside has a minimum acreage requirement for homes. So like Larry Ellison lives there, Ken Fisher lives there, like all the big, majorly wealthy. So Ken had an estate in the Purisma National Forest looking down on Half Moon Bay, and my desk was at a window looking at the ocean.
Oh, that's not bad. That's a pretty good office.
It was awesome. It was amazing. I mean, I can't speak highly enough of Fisher. It was a fantastic firm. But I left for Goldman because the commute was killing me. I was driving from the East Bay to Woodside, and it was like 2.5 hours a day of driving. So I went to San Francisco instead. So I was in San Francisco, Goldman in San Francisco.
But you went to Goldman first before you came to Portland, and what Dane is asking. But
correct. Yeah. Yes.
But you'd heard about Portland because Fisher was pushing all the propaganda on you to come up here.
Gotcha.
Correct. You got it. Exactly.
There we go.
Okay, you weren't ready. You had to take a baby step to the devil first.
Exactly.
Did I call him the devil? I didn't mean that. We were talking about Goldman, right?
Of course, yeah, of course.
Okay, so
did you buy Goldman stock after it crashed?
I don't remember.
There's some people that did pretty well off that, didn't they?
I'm sure. Yeah.
It was Bear Stearns. That was the big one. Anyway.
I don't think anyone made money on that one. That went to nothing and then got bought at like $1 a share.
What was the... I'm sorry. There was a play that... Anyways.
So you're working your day job and you're buying plexes in Portland.
Correct.
When does this transition?
So I left Goldman to work for a client's family office. And so in the family office role, I was doing, they were like a family office that was focused on technology investing. So they were a venture capital family office. And I was in charge of fundraising for them. So I built this huge network. And I was doing a lot of sales at Goldman too. So I was meeting a lot of very well-to-do people in the Bay Area. For the family office, this is kind of the same story. I was doing a lot of fundraising. I spent a lot of time in Mexico, funny enough. So we built like this huge network of billionaire family offices in Mexico and Latin America. Given my family's background in LATAM, it was interesting for me, and it was like personally interesting to go there. So we built this really robust network of people and also wealthy investors in the States. And we did that for a while. And while I was at the family office, I was actually pushing the idea that the family office should start syndicating, and I would help lead that charge for them. And they were open to it. They were kind of interested in it. But 2020 came, and the family office started kind of winding down. So I had a choice. It was like, do I go back to banking, which was easy. So I called a couple big banks, and they were like, yeah, we'd love to have you. Like, do you want to come on the private wealth team, blah, blah, blah. Or I could just try to go do something myself. So I said, and this was around May or June of 2020, kind of 3 months after the world went to hell with COVID. And I thought, okay, I have this huge network of people. I've been buying property myself. I have a little bit of a track record to point to. Why don't I just go try to syndicate capital? And if I can get one deal done, I'm in business. And then I got to do another one. And then I got to do another one. And I can just start building this thing that way.
How hard was that first deal?
Hard in so many ways. That's
not what I thought you were going to
say. I often joke in life and in entrepreneurship, like I think the things that would have killed me then, I deal with on a routine basis now. Mm-hmm. And the things that I deal with today would have absolutely killed me when I first started, like the stress and the anxiety of the things that I face on a given day now. So
you had to evolve.
You had to evolve, or evolve by fire, like a baptism by fire. So that first deal was insane. I mean, we got a deal in contract here in Portland in Johns Landing, and I had to raise the money. So I had to raise $1.25 million. Never raised money before. And people always come to me and they say, like, well, what's your advice for getting started in syndication? And my first piece of advice is, like, please start talking to people about raising money way before you need to raise money. Because if you're trying to raise money from people you just started talking to, you're not going to raise any money. Also, your top 10 guys that you think will invest with you won't invest with you. So you better have like another 30 behind them because and I did the whole thing. Like I read Joe Fairless's book on syndication, and it was like, build your power list of like your 20 guys that will invest. And I remember distinctly like my power list all flamed out, and I was like, now what? Like, what do I do now?
Were you scared?
Yeah. I mean, it's terrifying.
Yeah.
I had a bunch of money. I mean, like the risks of doing deals as a sponsor, you guys know, it's like you have so much money up on the deal, and if it doesn't work out, it's a huge loss.
Like $100,000 non-refundable earnest money.
Earnest money, due diligence,
DD, legal, everything.
Hey guys, Gabe here. Have you seen the exciting new projects we have going on at Stack Asset Group? If you're interested in investing with us, click the link in the description below.
And so, yeah, you have it's like do or die, like you have to close. And so I managed to raise the money, which was crazy, but I did it. And then, and we were supposed to close right before Christmas. And at the 11th hour, the lender tells me that they can't get their you-know-what together. And they can't close by Christmas.
Of course.
Of course. And they're like, we can't close till January sometime, which is crazy. And then my dad died. So my dad had been dealing with pancreatic cancer for 2 years. So he died on December 19th. And I'm supposed to close on December 23rd. And I've got $150,000 out on this thing. I've got no money left in the bank account. I've got the cash raised, but I don't have a lender. So we make a lot, and the seller needs to sell because it's an estate sale. So they're like, we have to sell.
And they wanted it to close before year end.
Before year end. So we managed to structure a seller carry to get it done. So they extended us a seller carry. I think it was in hindsight, this is all just like so incredibly risky, but like it was like a 6-month seller carry. It was like the lender needed to close on time. But we got it done. We closed on seller carry, and then the next month the lender performed and they closed the deal. But it was like every single emotional, like every single stressor hit me on one thing. I mean, and then my dad died.
And your dad's dying, yeah.
I remember distinctly. The other thing was they were not happy with my co-signing situation. Like they were like, oh, you can't sign on this loan alone, even though they said I could. And normally I would have gone to my dad because he's a cardiologist. And I remember like 4 days before he died, sitting next to him on the couch and being like, hey, Dad, like this situation's really crazy. And he's like exhausted. He's about to die. And he's like, I wish I could help you, but like what can I do? Yeah. And I was like, oh man, like what am I going to do? So I had to go find an investor from my deal that was willing to co-sign with me, all in like 7 days' time. I mean, it was crazy, like baptism by fire. But we got it done, and it worked out well. So it was
wow.
But yeah, that was the first deal. That was my first real syndication.
How many investors did you have on that?
I want to say 12 to 15.
Okay,
but none in your Power 20.
Not really. None of the Power 20 came through. It was all like
they weren't as powerful as you thought they were.
No, and
or maybe
remember,
too powerful.
And actually, I had a doctor investor that interesting enough, my dad was never willing to really help me with physicians. So like they knew me. That was a huge benefit for me. But like my dad was never willing to be like, hey, you should talk to my son.
Yeah.
So I took one of them out to drinks. He invested. And then he referred me to another doctor friend of his who, lo and behold, invested $250,000 in the deal. And it was like the first conversation. I mean, it was like just like luck, basically. Like, I mean, I think it was luck and preparation and the right pitch deck and having done the effort I'd done. But I mean, there's a lot of luck in this too. Like if that guy hadn't come through with 250,
it's timing.
I don't think I would have closed the deal. Right. Yeah. And so like that was an introduction from another guy. And I remember I took him to drinks and I was like, hey, we need more capital for this deal. Like, do you know anyone in your network? Like putting myself out there and asking for more referrals, which was nerve-wracking, as you guys know.
Would you say that that's one of your best sources for capital today is referrals from your existing investor group?
Referrals have been a big source of additional capital.
Because people already know you, they trust you, you've made them some money. Right. They're like, hey, come along, this is working.
Referrals are great. And we've since expanded into many different capital sourcing, right? So we have a big social media presence. We've raised a lot of money from people that find us through social media as well, which has been great. And that was not something that we historically had. It's like not an arrow in our quiver. And we built it over a year of like solid work. So, how
much of your background at Fisher and Goldman helped you in opening up those investor relationships and building that network?
I mean, it's huge. I mean, Yeah.
Because you were already doing the reps.
I was already doing sales. I mean, I think like, to go back to this, like people ask me all the time, like, how do I do what you do? How do I become a syndicator? And I always say to people, knowing how to underwrite deals and buy deals is great. It's a useful skill set. You definitely need to know how to do it. But if you can't raise money, you're going to have to go work for someone else because like it's the person that's close to the money that actually puts the deals together. And that was a saying at Goldman too, like be close to the money, be the one that controls the client relationship, have that relationship. So that was really drilled into my head from the beginning. And so, people always tell me like, oh, I'm looking at a lot of deals and I'm learning how to underwrite. And I'm like, forget it. Like, that's fine, do it. But like, please go take people to coffee and just start talking about investing and like get people convinced with your story, what you're doing. Otherwise, like, go work for someone else that can raise money and you can underwrite their deals.
So you're way smarter than I am. Tell me why you were off building your own portfolio. Where did you arrive at the conclusion you need to be a syndicator instead of just continuing to do what you were doing and building your own portfolio?
Ran out of money.
So you wanted to do more deals, bigger deals, and you needed capital to do that.
You needed there's two catalysts. One is I was planning to continue the route of just redeploying revenue I earned from my W-2 and carry, right, because there was a carried interest component to working in venture capital. And my thought process when I was at Goldman and when I was at the family office was that I was not going to syndicate. I was just going to take everything I earned and buy real estate with it and just steadily build. Because I would look at guys at Goldman who were making 10 to 15 million a year and I'd be like, why aren't you just buying a ton of real estate with that and just building a huge portfolio? So that was always my plan. My plan got thrown off by COVID and losing my job. And then it was like, now it's like either I can continue on this plan and go work for a bank, which I didn't really want to do. I had enough experience to know I didn't want that lifestyle anymore. Or I could try to syndicate. And I knew enough, just barely enough about syndication to say like, let me go try to start this instead and just build something for myself. And I'd had the entrepreneurial itch for like a decade, right? So as I worked at Goldman, even at Fisher, and as I worked at the family office, I was always thinking like, I really want to have my own thing. Like I want to build my own company. I want to do my own thing. I want to have freedom, however you define freedom. So it was a choice.
So would you say you were born an entrepreneur? Or did that have did you have to evolve into that? Or did you think, because you went to work for other companies, going into that, was it, I'm going to learn something to go out on my own? Or was it, I'm comfortable and safe and I'm making a good income, so I'm just going to keep doing this?
I think I fluctuated back and forth. So I think when I started in finance, my goal was always to have my own registered investment advisory firm. So manage other people's money. That was always my goal. And it was always like, how do I parlay this into doing that? There were times when I was at Fisher when I had opportunities to take kind of higher level management roles within the company where I was thinking, well, okay, this is a pretty good life. You make good money, great benefits, and like I'm not going to have the freedom that I'm seeking, but I'll be comfortable, right? And then those, either, like for whatever reason, they just didn't happen. So when I went to Goldman, I think the people at Goldman are generally very self-interested is one word, but how do I parlay this into my own benefit? It's not a lot of like, oh, I'm really loyal to the firm. It's like as long as the firm and I have a good symbiotic relationship, we're good. And there were two tracks guys took in the private wealth department. They either built huge portfolios and client bases within Goldman, and then they made a ton of money and they got golden handcuffs, right? The firm would give them an enormous amount of unvested stock. And if they left, they lost that stock. But there were a couple notable examples of guys that left Goldman and built massive individual investment firms and have made hundreds of millions of dollars as a result. So I always had that model in my mind. It's like, that's kind of where I want to go. Real estate happened when I was at Goldman. I started really getting interested in it and realizing this was another path I could take. So I don't think I was born an entrepreneur. I think maybe my ego couldn't handle working for someone else forever.
But as you stood on the precipice looking at two paths, you could choose freedom or comfort, and ultimately you chose freedom.
Freedom and lack of comfort. Yes.
A lot of lack of comfort.
How do you define freedom?
That's why I said it sort of facetiously before. It's a good question, Mike. How do you define freedom?
Or do you feel like you have freedom?
I feel to an extent like I have freedom, but not really.
And that's why you can't define it, probably.
Yeah, exactly. Yeah. I think there's an allure to being an individual business owner because you think that you'll be free, right? Like, I don't have a boss. I don't have anything. The reality is couldn't be further from the truth. I have many bosses. Yeah. I have all my investors are my bosses, right? And so like you report to your investors, and when investors are unhappy with you, it feels like your boss is unhappy with you.
Yeah, but they treat you differently. And you mentioned the athlete complex.
Yes.
How much of that do you think drives it? Like being where you're at.
Yeah.
Like you're relaying some things where I can relate to that, which is I didn't want to be in a job because I've always been built up my entire life, whether I wanted it or not.
Right.
So you had this fake ego piece of belief you may not need to have. So you can't be refined in a job, but at the same time, you don't want to do everything yourself.
Right.
And now if you're now responsible for other people, and then they believe that you have a commitment to them, a partnership.
Right.
You do have a bunch of bosses.
Yeah.
Yeah.
Yeah. I mean, I think, and I think syndicators come in, sponsors, syndicators, whatever you want to call it, come in a variety of shapes, sizes, and forms, right? Some take their duty to their investors really seriously. Some view investors as a funding source, and they'll move on and kind of burn it, and they don't care, right? And so, I suffer from a fair degree of Catholic guilt, and just like constantly like, okay, this is my fault. Like, how do I deal with this? So I think I take the fiduciary response, and I also come from a background of being an actual fiduciary, right? Like I was a licensed Series 7, Series 63. Like I was an actual fiduciary to my investors or my clients. So I've always taken that mentality. So it feels like I have a boss in that sense. But it's different. Like you said, it's different. It's not really the same. And ultimately, like if an investor's unhappy with me and they don't want to work with me again, the business goes on, right? Like we're okay. It's like if a boss is upset, not that I want that to happen, but like the business is survivable beyond that.
And I like that word. It's not really a boss. It's a fiduciary. It's a fiduciary responsibility. That's how you're looking at it.
You have a duty to your investors.
Yeah, yeah.
And unfortunately, not everyone takes that perspective.
Well, and, I posted a question on social media today, like what's the difference between a partner and a syndicator? And I think a lot of people are getting in syndications, and if a syndication goes bad, which we're seeing right now, is they think they're getting into a partnership. And they think it's the syndicator's job to bail them out of the partnership.
Right.
But unless you have a partner mindset as the syndicator, that's not your role.
Right.
And that's not your job.
Right.
Your job is to go syndicate something else.
Right, exactly.
And go sell another deal and raise more capital. And then the optics of that spoil everything for what you're doing in the deal that went bad, because you went through it with not the mindset of a partner, but the mindset of a syndicator.
Right.
And so there's this blend of like what you did, and you did a good job exempling. It was like you made a decision that you still want to invest in real estate, but you need to make now money. And so then you decided this is the vehicle for you, the easiest way based on your skill set and what you've accomplished to make now money and build your portfolio at the same time. And so what I'm hearing is someone who built it as a partnership mindset with the fiduciary background,
right,
versus what we saw a lot out of 2020, which was people that went exactly what you from, which was underwriting and skills and finding a deal, to now it's really easy to align with money.
Right.
And that's a syndicator mindset without a partnership that's going to say, here's how we're going to get out of problems if we're going to get out of problems.
Right.
Yeah.
Yeah, absolutely.
Cool.
And I'm not, of course, like we did deals in 2020 through 2024. Some of them aren't great, right? And so like extricating ourselves from those is painful.
Extricating
or protecting investors or whatever. It's a painful process. And I mean, but also like I've learned like, uber transparency, doing the right thing. I've made many decisions in this business so far that are definitely a negative financial decision for myself, but positive for my investors. And I don't know that everyone will do that. Is it going to matter in the end? I don't know. Might not on some deals. Might matter a lot on others. But the point is like, to a fault, I think I've been willing to take lumps to protect my investors as much as possible.
How much of the timeless investor mindset plays into that versus looking long-term versus short-term?
Yeah. I mean, I think like the timeless investor ecosystem we're building is really focused on building something enduring.
Can you tell us a little bit about what you're building?
Absolutely. So I studied history, as I mentioned, and philosophy, poli-sci. So I like that stuff. And I really think I made a comment earlier, like the most useful degrees, right, as a joke. But I actually think history and poli-sci and philosophy are really useful degrees. I actually had a moment when I interviewed at Goldman, and I'll get back to the timeless investor in a second, but where they were like, "Well, you didn't study finance, so like, why should we hire you?" And it's a trap that I think catches a lot of people, because you find yourself in this position of like trying to justify like your life decisions and like why I studied X, Y, and Z. And I remember I was like, well, I can go two directions here. I can either be like, you're right, like I probably should have studied finance and like I kind of feel bad about myself, or I could be like the defiant route. And I went the defiant route instead. And I was like, well, actually, I think your finance degree is relatively useless. Like, I've learned everything you know on the job anyways, and I have the CFA. But what I have that you don't have is I can see history and trends, and I think differently about the world than you do, and I think differently about the world than 98% of the people you hired. So tell me why you think a history degree is not valuable. And the guy was like sort of floored.
Wow. That's an answer.
And psychology is the foundation of finance.
It is. I think every investor should be a psychologist, personally. Like, you have to understand. So anyways, that's been my take. And whenever people tell me like, "Oh, I didn't study finance," I'd be like, "Forget it. Like, you'll learn all." Like,
It's the worstest degree.
It's the worst.
I still love you, Dane.
Yeah. I think
Dane better go study some history and poli-sci.
Get on the history. But that was my argument, and obviously it's my worldview because that's my situation, right? So if I had a finance degree, I might argue something different. But that's the way I looked at it. But I think the key is like, don't let other people define you. Like, define yourself for people.
Yeah.
And then so the Timeless Investor came about because I realized at some point I was on social media and I was like very dipping my toe into social media. And I recognized that there's this amazing potential to meet new investors and really interesting people and build a brand on social media. And if you're not doing that, then you're just the eyeballs for social media to make money. So the social media world breaks down into two groups of people. The people that exist on the platform that they sell advertising to, or the people that use social media to actually build their brand.
Creators and consumers.
Creators and consumers.
Like the whole world.
And I was a consumer, right? I was using it. I would go every once in a while and I'd like repost an article and like I'd be like, oh, this is interesting. And I'd get like 2 likes and I'd be like, why isn't this working? So I made a concerted effort starting in early 25 to like really build a brand. And I started like everybody else in the real estate influencer world of like, posting sort of blasé posts about real estate. Like, oh, I don't like fixing and flipping and here's why. It's kind of like standard stuff. But I really love history and I've always said like if you don't understand history, then you don't really understand why the world is the way it is today, right? And like my wife's a classic example where she's always like, oh, I never really understood history and I didn't really appreciate it. And I'd be like, well, have you considered like, because this happened, this led to this, which informs like the way the world is today. And if you didn't understand that, you can't really understand why we are where we are today. And she'd be like, oh, that's really eye-opening. So I started writing longer form articles on Substack, which is a great platform. And our first like really viral post was the bloody history of interest rates. And I went back through like 150 years of interest rates and how there's a very cyclical pattern to interest rates. And that post got like 500,000 impressions and drove like 1,000 newsletter subscribers and like blew the brand up. And I realized like people really liked these historic deep dives and like learning what worked for great builders in the past, what worked for the Medici family to build a real estate and banking fortune, what worked for the Hanseatic League to build like this incredibly robust 500-year perpetual REIT in the Northern Sea, right? And like how can we take those lessons from then and transport them to today? So that's the brand, right? So we've been really focused on the throughput of history, understanding these stories, and building that. But then to your question, Mike, like what are the timeless principles that inform lasting success over the ages over a long time, right? And so one of them is building a compounding, mutually supportive enterprise versus taking an extractionary model instead, right? And you have a lot of examples of empires and people and companies and business people that have taken an extraction first approach, right?
Tell us more about that. Yeah,
I mean the classic example that I give from a historic standpoint is nations that incentivize like extractionary economics. So the classic example is the Ottoman Empire brought in a tax farming system. So the basic premise of it was you would buy a contract to own a region and you would pay the Sultan the fee. And then as the tax collector, your job was to extract as much wealth from that region as you could possibly extract. And so they would bankrupt farmers, they would destroy local businesses because they had paid and financed the money to the Sultan, and then they had to extract as much wealth as they could to line their own pocket, right? And the Apostle Matthew, for example, was a tax collector, and the Romans had the exact same system. So the reason the people all over the Roman Empire hated tax collectors was the exact same system. They would buy the contract and then they would extract as much as they could from the people. And the throughput to that is like in real estate, I think there's a really clear throughput. Like you can be an extractionary real estate owner where you're like, and there's many owners, and we've looked at several deals where they don't invest in the building, they don't take care of the building.
Slumlord.
Yeah, slumlord, and they extract as much as humanly possible. The question is, can you build a compounding engine instead where like you're a good owner and maybe you don't clean up as much on cash flow, but does that build a lasting legacy?
More sustainable.
A more sustainable business. And you see that with empires, you see that with builders, and you see that today.
Yeah, extraction has an end date.
It has an end date, and it doesn't, and that's it, right? And
it's short-sighted.
It is, yeah, exactly. And so I think the other big thing that I've taken away from studying this is a long-term perspective, right? So the other classic example is like the Grosvenor family out of the UK, right? They've owned the same real estate, Mayfair and Belgravia, for 350 years. They've never sold it. John Jacob Astor, another classic example. Astor was one of America's first great millionaires, and he took his fur trading revenue and he bought land in Manhattan before it was Manhattan. But because he understood global trade patterns and where Manhattan sat and everything, he just kept buying land north of Wall Street. And then he would do long-term ground leases, but he would never sell the land. And he just kept buying Manhattan real estate, never let go of it. And the Astor family was very wealthy for 200 plus years. I mean, they might even still be Astors out there today with wealth.
Then he went to Astoria.
Mm-hmm. And then he did Astoria.
Which tried to build Manhattan and Astoria.
Which, if you haven't read Astoria, it is a mind-boggling book. The book Astoria about the founding of Astoria is unbelievable. Unbelievable. But yeah, that's a very long-winded answer to your question.
I love it, dude. This is good stuff. You just ask a couple questions and he carries the whole episode.
To clarify, you said that when you made decisions that were more catered towards the investor that at the time weren't financially favorable to you, you were just talking about the time frame in which they were financially favorable to you. Because I think you believe that in the long term they are going to be financially favorable to you.
Agreed.
And that's the paradox that you put yourself in, where you say, okay, my assumption based on the way that humans think and act is that even though in the short term this feels as though I'm not extracting as much value as I can, I know in the long term, as long as I keep doing what I'm doing, I'll actually make more money because of it.
Agreed.
Yeah.
Agreed. I think that's always the mentality, is like your investors are your business, right? And so you have to take care of your investors first and foremost. If you burn all your investor bridges, you don't have a business. And I recognize that, which goes back to, are you truly independent and free or not? You report to a lot of people. So
to be in real estate, you have to play the long game. I guess you don't have to, like we're talking about slumlords and stuff. I just wonder, like for somebody who wants to do this, is relatively young, that wants to do it for a while.
If you want to have a soul, you have to.
To me, you've got to do it for a long time to get the compounding value of what you're doing. And if you have all of these deals that are out there that may fall apart and the investor relationships that fall apart, to me, it's just you're not getting any traction. You're just spinning your wheels. Like Mike was talking about, you do a syndication. Well, that one failed. So what? I'll go do another one. To me, that's not building something for tomorrow.
It's not fundamental.
It's actually not building anything.
Yeah.
It's just you've got a machine that you're able to pay yourself out of, and when that one blows up, you go build another machine.
Yeah, I think the way you want to look at it is like, do you truly want to own that real estate?
Right.
Because if you don't truly want to own that real estate, the asset management portion of it's going to suck.
Yeah.
It's just because you're going to have to answer questions you don't want to answer, and you're going to have to think about a property you don't want to answer. And so it really has to come from, are you an owner and an operator? And I've had this conversation so many times, like, don't call me a syndicator. Yes, I am syndicating money, but I am an operator, and you have the benefit to ride on my shoulders. And that's what this is. All we're doing, and I'd love to hear your thought process on this, but because we just completed our first syndication, and it's a freaking long, emotional estate planning conversation. Like allocation. The whole conversation is allocation and trade-offs and why we're investing in this and what type of capital you have and what bucket, and is it better out of a 401k or should it be and it's just this long conversation just to buy the property.
Yeah.
And then the responsibility and the fiduciary begins after that. And so if you're worn out before you own the property, it's just not successful.
Yeah. Well, and I think I think, for investors listening, I think it's also important to understand that being a syndicator is like, you're really a glorified broker, especially to start, which is there's this like fundamental incentive issue in this business, which is we get paid a lot of money to do a deal. It just is what it is. You get acquisition fees, loan fees, different things. There's a theoretical payout at the end. And so there's a constant push-pull between like, well, I got to pay my mortgage and I have to be able to feed my family, and then also need to do the right deals. And it's difficult as somebody that started a syndication business at, frankly, the wrong time in history, in my humble opinion now.
That's full agreement. Full agreement.
It's a tough time to start, no question. And that's why I say like it's not all roses, right? There's a lot of like difficulty in the business right now. But like I've always tried to balance that harsh reality, which is like unless you're closing deals, you're not getting paid, and then I can't really be a syndicate. I can't do it. I can't be a sponsor anymore. And so that's a mountain that every single person that gets into this business basically has to climb unless they have an independent funding source at the same time. And so like how do you manage that conflict is the big question.
Is it important to have your own side stuff going on then?
What do you mean by that?
So like I have an acquisitions and development company, and I have a lot of partnerships, and we have now syndication. I believe my activity on the acquisition and development side brings safety into all those partnerships because that brings significant more resources. It keeps us in the market. We're looking to see, we are invested in this community to a level that we are looking so far ahead that we're adding a level of safety because we're not just syndicators, and because we are flipping houses, and because we see the politics, and because we are meeting with sellers, and because we have management that's meeting with tenants. And so it's this other level of activity that creates this ecosystem of safety and risk mitigation through that structure.
Yeah. I mean, I think that's a way to do it. I guess as I think about my own journey, like in the beginning, it was just me, right? And I'm making a decision, and I'm having to balance the need to make money with the need to make sure I do a good deal. And what has happened in syndication is that you don't see the negative effects of a bad decision for 3 to 5 years, but you get an immediate payout at the front end to do a deal, right? And so that's a conflict in this business. It's like, how do you get around it? I don't have a good answer.
Because you're motivated to do deals, whether they're...
You have to... Well, not only are you motivated, you're extremely motivated because you have to do deals, right? And so
because you've got a team now, you got payroll, you've got
a bunch of stuff, and so you have to continue to do deals. And your goal is to get to a point where you're earning enough in asset management fees and rental income that you don't have to do deals. But that's a multi-year process when you're first getting started. So for a while, you just have to do deals. And so I think like for me, I was sort of multi-geography from inception, right? So like I was in the Bay Area. I was investing in the Bay Area. Many of those deals I sort of regret today because the Bay Area has been a really difficult market. But we were also investing in Seattle and Tacoma and Portland. So I was looking at multiple geographies. And I think the one thing that I would say sort of saved us is we took a very contrarian view on where to invest, right? So at this time, everybody was doing the Sun Belt Exodus thesis, right? And money was pouring into Texas and Florida and all these different places. And, we had a deal we bought in 21. It was a 59-unit building in Portland, and we financed it with 3-year bridge money, September 21. So you can think about the timing, the interest rate.
Where at?
On the east side, right by Mount Tabor.
Okay.
It was a good deal, actually, objectively a pretty good deal. But we had to refinance it in 24, and we had to do a capital call. And it wasn't a dramatic capital
rates
call.
were double.
Rates were double. And we had to do a CMBS takeout. It was the whole thing.
So you had to do a capital call on your investors for a cash-in refi.
We had to do a cash-in refi. And it wasn't like a dramatically large cap call. It was like 10% of the equity.
But it's at the point where investors are hoping they're going to get some or all of their capital back. Instead, they're putting more in.
They're putting more in, right? But my point is there is a Southern California firm that will remain unnamed that bought a bunch of Texas properties at the exact same time with the exact same lender, with the exact same business plan. And all of those deals are complete wipeouts. And they're like in the news, and I'm not going to say their name, but they're in the news, and it's a big issue, right? And I look at it and I say, we got sort of fortunate that we were investing in Portland, because when I pitched this deal to our lender, they were like, oh, that's, you got to keep your rent growth estimations down. We think your turn flip numbers are too high, right? We ended up being right on the money on all this stuff. But if I'd been doing a deal in Texas at the exact same time, I probably could have argued for 5 to 10% annual rent growth and much higher numbers because everybody was really bullish on the market. And that's why those deals blew up and ours didn't. So I think having a contrarian thesis on where to invest was really, really beneficial for us. Like I think we've avoided a lot of the really big problems that have hit other people. But it's also useful because if you're just in one market, you don't really know that your market's boiling, right? So my anecdote I give is I looked at Denver for a hot minute. There was like a 1 year period where I was looking at Denver. I was flying to Denver. I was looking at deals. And every single deal in Denver was a 3.5 cap entry price with a 4.25 cap exit price. And the brokers were like, trust me, man, like you will be able to sell this for a 4.25 cap. Like that's conservative. Every single deal in Denver was $100,000 to $200,000 released at mutual signing of the PSA just to get the deal in contract. And I bid on probably 5 or 6 deals. I lost every single one because people out of San Francisco and other markets were buying, and they were buying for more, and they were releasing money at closing just to get the deal. They're like, if you just take my agreement, I will give you $200,000.
Released right away.
Released right away. And I was like, I don't really want to play this game. And because we were looking at all these other markets like Seattle, I would be like, well, I can find deals in Seattle. In hindsight, they were still expensive, but like at a high 4 cap or a low 5 cap. And Denver's everything's a 3.5 cap. So I'm just not going to play in Denver. It doesn't make any sense to me. I'm going to go to Seattle instead. And that sort of saved us, right? Like so being multi-geography allowed me to see which markets were irrational. And I actually remember very briefly calling a broker in Austin and just being like, yeah, what's going on in the market? And tell me about it. And I mean, the cap rates there were like 3 caps. It was like, they were like, oh, every deal has 20 offers and everybody wants to buy in Austin. And I was like, okay, I'm hard pass. And we got wiped out. Like you would have gotten completely wiped out on those deals.
Okay, I have a 2-part question for you. Do you think that can you speak a little bit to the pain in the real estate market, commercial real estate market over the last 3.5 years? How is that? Where have you experienced pain? And also the other question, follow-up, is do you feel like there's a silver lining to you launching your syndication in the middle of 20? Like, is there anything positive to the fact that you launched during a very hard time?
Yeah, the pain. I mean, the pain is stuff that's been repeated ad nauseum on every podcast, right? Interest rate or
values went down, expenses went up, rates went up, everything went wrong.
Insurance premiums are brutal, right? Like we were not a buyer of like 2020 buildings either, so we owned like 70s and older, and so our insurance premiums have skyrocketed. The irony, I just talked to an insurance broker yesterday. He was telling me that now they're having a hard time insuring new buildings because a lot of the sprinkler systems have been erupting and causing extensive water damage on new buildings under freeze conditions, which is fascinating. So he's like, really, it's hard now to place insurance on new buildings, and it's also hard to place on old buildings. It's just hard to place insurance, which is like not what I would have expected. But yeah, I mean, insurance premiums are up, costs are up. I mean, I think the silver lining for me is it has forced me to be a better operator. Mm-hmm. So I think like guys that I made a joke at the beginning. I wish I'd been buying in 2010, and I still wish I'd been buying
and earlier.
I still wish I'd been buying when I got out of college. But you know, I think I think that a lot of the really dramatic blow up cases right now are the guys that started buying in 2010 and had 10 years of unmitigated growth, right? And everything was great, and they could not pay attention to operations. They could not pay attention to what was happening. They could hire any management company, and everything was fine.
And then COVID hit, and they went big because they had the ability to.
And they went huge, and they'd had that base to go big.
Yeah,
exactly.
You didn't have that base when you started.
Couldn't do it.
Yeah.
And you know, I think it's a classic overconfidence bias, right? Like you build confidence, earned or not, right? And the question is like, are you? I will never forget talking to a guy. Again, I'll leave his name out, but and they've done really well actually. They're not a problem, but they started buying in 2010. And I made a comment one time, well, that's a really nice time for you to have started your company because they own 20,000+ doors now, and they're huge nationwide. And he was like kind of offended by it. He was like, well, it's not just the timing. Like we're good investors too. And I was like, okay, but like it was mostly the timing. Like you hit the
had to have both.
Yeah. Maybe you're a great investor too.
The velocity was impacted.
It was
by
helpful.
The time.
It was helpful.
You had quite the tailwind.
Yeah.
And that's the whole like beta versus alpha in investing, right? Like beta is like you ride the market and you just get what the market gives. Are you really producing alpha is a big question. And it's hard to say. So I think the silver lining for us, frankly, is like it's changed my mind in terms of how to be an operator, how to run real estate. I think I had gone into it with everything that was kind of taught on Bigger Pockets, and all the information that was out there was like buy, scale, outsource to other people that are going to run it for you, and just keep growing. And I think myself, and I think a lot of other people in the business, have changed their perspective on like, what does it mean to be an operator?
That's always thing is like, that's a finance mindset and not an operations mindset.
Absolutely.
And it's a lot easier to sell a finance mindset than an operation mindset.
Absolutely.
And that's what
It's more exciting.
it's
It's
dreams. You're selling dreams.
Yeah.
You're not selling work.
100%.
Yeah.
And the operations piece is like, I think it's been eye-opening to be like, oh, we need to be like dialed as an operator. And so like a lot of the stuff that we've done recently has been focused on vertical integration, right? Like, so
Nice.
trying to like control all the cost inputs, manage everything in-house, do everything that we can to just like have our hands on the pulse of what's happening. And I actually people ask me all the time, like, oh, how do I get started? How do I get started? And my advice now is like, go buy a fourplex near your house, manage it yourself.
Yeah.
You can definitely work with a good third-party management company. There's no question. But like in the beginning, you should just do it yourself. So at least you understand how it works so that you can be a better operator later.
Psychology.
Yeah. Well, yeah. And like, do you know what's the input to like get a lease signed? Do you know do you know how Zillow works? Do you know how the systems work to find residents? Do you know what resident complaints look like? Do you know like how to increase retention? Like and I think there's a mentality of like, I want this to be passive. I want to buy a property and I want it to be a passive investment. And I've just, unless you're an LP, it's not a passive. Real estate's not a passive.
Yeah, we say passive. One of our partners says passive is a tax term.
Yes.
Yeah.
Passive investing is a tax term.
Absolutely.
You want to own real estate and you want to sit back and collect checks. Good luck with that.
Yes.
Great
exactly.
statement. There's only two ways to be passive in real estate: making loans and being an LP.
That's right.
Exactly.
And even making loans is
That can right now. It's not very
Not
passive.
very passive. Yeah, absolutely.
Gosh, how many?
Owning real estate is passive.
It's funny how many
Operating is
real
not.
estate is not passive.
When you're raising capital, it's amazing to see how many people have bad loans out in the market, private money loans. You're just like, I had no clue that this many people are loaning money privately and just getting taken advantage of. And then also, there's a stat out there, we should actually look it up. How much money in self-directed 401ks is sitting in cash?
Yeah.
Just not being invested.
Yeah.
Yeah, it's interesting. The psychology of money.
Speaking of lending, in retrospect, I'm thinking about your deals with 3-year bridge. Would you do something different today? Would you look at 5, 7, or 10-year more quality debt? Would that help you in some of the pain that you're feeling right now?
I would. I love that you asked that question. I will never use bridge debt again. I'm burned of it. I'm like the generation after 1929, 1930 who will never buy stocks again. I'm the kind of guy that was like, I don't want to use bridge debt again.
Tell us why.
Well, I'll tell you why, but I'm going to couple with a story. So I have a mentor in Seattle who owns 2,500 doors and like 500,000 square feet of commercial real estate, and he's been in the business for 53 plus years. And I interviewed him on my podcast, and I said to him, "Have you ever had a capital call?" No. Have you ever given a building back? No. And I was like, well, that's a lot of cycles you've been through. I think he's been through 6 major downturns. And I said, well, what?
10-year fixed rate debt.
Basically, well, it's interesting too, because when he started, 10-year was like the shortest available. They actually had like 30-year options. But he told me, that was words to live by. He's like, 100% of the time, we took less money than the lender wanted to give us. 100% of the time. And he's like, and I knew I could eke out a higher return, and I maybe could have made more money if I'd taken more debt. But I was willing to take a lower return in return for less debt. And he's like, and that's been our saving grace.
He balanced his risk.
But it's interesting because to go back to this point of starting a syndication business, like when you're first starting, your pitch is what your pitch deck says the return on the deal is. And the way to engineer the higher return is to take more leverage. And so in this period of hyper competitiveness for deals and money sloshing around, you were incentivized to take 80, 85% qualitative leverage with 3-year bridge.
Yeah, you want to advertise the bigger return to your investors. So you can.
What's qualitative leverage?
I have two.
It's
I have
hard.
2 thoughts that are straight down this same path. The first one that I just think is funny is I met with somebody who was talking about a platform that connects like LPs with GPs, whatever. There's a ton of them, but one of these platforms, the LPs will like pay to be on it. And so it's like actually a pretty effective one apparently. But they said that the LPs that are on there, they've kind of made it slightly more private, but they're all educated investors. And all of the LPs that end up on there, they said that the highest filtered for like setting within like when you're searching for just new GPs, like looking for deals, the highest filtered for within real estate was returns at 25%.
Or below.
Or less.
If it's over that.
Not more.
Red flag.
If a GP's advertising, because real estate generally is offering the same returns everywhere. Right? And so if you're getting beyond that return, you either don't know what you're in for or you're leveraging 95%. Right? And so that was piece one. Piece two was we have an investor who we've worked with on a number of projects now, but every deal that we bring to him, he cares so much more. So he came from institutional, like he ran a fund he did billions and billions in transactions of real estate, and now he just does the private side. He was doing that for a pension fund. But whenever he looks at a deal, the only thing that he ever cares about is your yield on cost. He will never refer to a cap rate because he's like, dude, I don't care what your cap rate is. I want to know what the actual yield on this deal is, irrelevant of interest rates and how much you leverage it. I don't care. I understand that we can get a better return with leverage and we're going to use leverage. Awesome. I want to know what our actual yield is because that's where the alpha is, right? That's how you give the distinction between what's the beta that you're creating just by like financial engineering versus like real alpha. And so he's taught every time we look at a deal in order to present him something like, and that's how you know what he wants to see is all he wants to see is show me the alpha. Show me where you're actually creating it, because then I can underwrite this deal. Like I can look at a deal anywhere and I can know if you can show me numbers that you're genuinely trying to present as realistic, and you can show me that the yield on cost is greater than what the market's yield on cost should be, or the yield on cost that you're purchasing it at. Awesome. Yeah, let's do the deal. Yeah. And there's a spread level that 200 basis points that he wants to see. It's like, awesome. Yeah. Even if the deal goes like kind of wrong, we're still going to be on pace to own a good deal. Yeah. But it's like irrelevant of leverage. I want to see that.
It's a smart way to look at it. I mean, the guy I mentioned told me that he's never in his life in 53 years pitched IRR as a metric. And I was sort of
Did he say why?
Well, he said it's funny money, and which I totally agree with, and it could be manipulated, and is it true?
It's not real.
It's not real. But I was sort of laughing about it because he was like, well, you just need to be like, do you like the real estate? If you like the real estate, you should buy it. And I was like, well, I don't, I don't say it's a problem. I think the issue is that syndicating capital 30 plus years ago, you had a completely different investor mindset. And investors today are very, very trained in modern portfolio theory, efficient market hypothesis.
The education level is significantly different.
Significantly different. So if I were to go now and be like, listen, like this is kind of what we think the cash on cash yield is going to be, and we like the real estate, so you should invest. I was like, most people would be like, okay, pass.
I just have a feeling about this one. I like it.
I like the property. It's like, but he was like, that's how he invests, and he can do that because he's been in the business for 53 years.
Well, and he knows what properties to like because he owns so many of them. If you're just getting in, you don't know what to like yet. We've been doing it 53 years. You can go like, oh, I like this deal because it's just like these other 5 I did that made me a bunch of money.
I like the real estate. I know it's going to perform.
Yeah. So it's interesting because I've tried to move a little bit away from IRR as like the pitch metric because I also think it's BS. I mean, we've been really I cut my teeth in value add, and we've been pivoting towards just basis cash flow deals today. Trying to take less leverage. I'm trying
reposition.
And I'm trying to just execute on what I believe, which is like sustainable economics, sustainable system, right? And I think, you asked me why I burned on 3-year bridge. I mean, the reality is a lot of negative things can happen in 3 years. Mm-hmm. A lot of negative things could happen in 15 years, but it's less likely.
It's just such a short runway.
It's such a short runway. You don't know. There's so much prediction risk, and this is why I never got into development. Because I never understood. I just felt like the risk between like you get your permits approved, breaking ground, and then you're finally leasing up. Like it's like kind of like a short-term bridge debt, and you don't really know what your environment you're going to be delivering in at the end of it. And as we've seen, there's development deals that are not doing well right now because they're getting delivered right now. Right, they were built in the best of times and they're being delivered in the worst of times. And like to me, it's like time solves most problems. So if you can hold for longer, the fundamental difficulty is most LPs today are not willing to leave their money in a deal for 10 to 15 years.
Yeah.
So that's why syndication.
They want a 3 or 5 year round trip.
And it helps the IRR, as you know. So like the shorter term, higher IRR. So makes it a more pitchable deal, which investors then go to. So sponsors are incentivized to financially engineer higher returns with shorter hold periods and higher debt, which can work great. And it worked great from 2010 through 2023. And then it catastrophically fell apart, right? And so, yeah, that's.
I don't know if you talked a little bit about Timeless Investor. This is your platform. Can you tell us a little about what your goals are with this platform? What do you do? Is this just you tying history and psychology to the hypothesis of how you invest, why you invest, or what are you doing with that platform?
I mean, it's mainly like a personal interest of mine, but certainly we have business goals with it. So I published a book. So I wrote a book last year that we published called Timeless Wealth, Real Estate Through the Ages. And it was all about how all of the OGs throughout history built real estate portfolios and the different strategies, right? Development, leveraging government benefits, like a bunch of different ways to play the real estate game. And that was sort of the catalyst, Timeless Wealth. And then I used the timeless word to kind of start the Timeless Investor. So, I mean, I think it's a multivariate thing. So I'm working on my next book. So obviously having a large social media presence helps with launching a book. There's an obvious benefit for me in that getting our name out there helps with capital raising, right? So the more people that are hearing from me, kind of hearing what we're doing, more interested in investing in our deals, raises more capital for us. There's a media empire style focus too, right? I mean, YouTube can produce meaningful revenue for the business. The advertising revenue on YouTube is meaningful when you get to a certain point. So that's compelling. And it was always impressed on me for a while that having a private newsletter with controlled email addresses and having people that listen to you is only positive for your business. There's really no negatives to doing it. So we've leaned into Substack as the platform we use. And we have, I think, 3,700 people right now that are on our newsletter that receive ours 3 times a week. They receive information from us. They receive articles. And that's a fundraising source for us, right? And we can... So there's a lot of tangential benefits, and I think it's all beneficial for the business.
So if somebody wants to subscribe to this, go to Substack, Timeless Investor. They can sign up for your newsletter.
You just Google Timeless Investor. I think the entire front page is us.
Okay.
There's one guy out there that has a small website that has the same name that he's up there too, but not competitors or anything.
Okay.
It's mostly us. So yeah, Timeless Investor. We're everywhere right now. So.
All right. Is there anything else we didn't cover that you'd like to talk about with your business right now before we end this first episode?
I don't think so. This was a great conversation.
It's fun hanging out.
We went to lots of different places. This was fun.
Okay, we're going to wrap this one up, guys. Arie van Gemeren. I'm saying that correctly. All right, I got it right. Founder and CEO of Lombard Equities Group and starting the platform Timeless Investor. If somebody wants to reach out to you, they want to invest, obviously they can go Substack. They can Google you, Timeless Investor. If somebody wants to reach out to you direct, do you have a team that they can email or can they email you?
You can email me directly.
Give us your email address.
Arie at Lombard Equities.
Spell it because it's 4 letters.
ARIE at LombardEquities.com.
Arie at LombardEquities.com.
Correct.
Arie, thanks so much for being on Deal Junkies.
Thanks.
It's really fun talking to you. We're going to follow up. We're going to talk. We're going to dig into some deals in the next episode. Deal Junkies, we love you. Thanks for listening. Please share us with someone because we want to be famous like Arie one day. And we'll see you next time.